If you're watching this right now, I'm willing to bet that you're feeling the economic downturn in one way or another. Maybe you don't feel like your job is safe enough, or you had to take a cut in pay or benefits. Maybe you're worried that your life savings aren't secure enough anymore, or maybe you want to make sure your family will be taken care of if something unexpected happens in the future. Whatever the reason, many people are looking to invest aggressively right now to secure another source of income, and with a good reason.
Hi, this is Invemon, and today we will talk about 5 reasons you have to invest during a recession.
Number 1. Stocks are down from their all-time highs. All major US stock indexes are down from their all-time highs, and the media are full of articles and news about the stock market being in a slump. As of November 2022, everyone is expecting the market to continue to drop. Contrary to the opinion of many, this is usually the signal that the stock market is nearing its bottom. And when everyone is fearful, it's time to be greedy. However, as Matthew McConaughey said in The Wolf of Wall Street, nobody, I don't care if you're Warren Buffett or Jimmy Buffett, nobody knows if a stock will go up, down, sideways, or in fucking circles. So rather than picking up the true bottom, focus on picking up the right investments. Don't take us wrong, we are huge advocates of dollar cost averaging into broad market ETFs, but recessions like this one bring up great buying opportunities that even we simply could not ignore. A lot of growth and value companies are trading at a fraction of what they were at the peak at the 2021 bull run. However, we are not keen on giving any stock tips or recommendations, so do your own research before picking the companies. There are plenty of tools to help you with that, whether it's reading financials, getting price multiples, or going through the latest earning reports. Just make sure you really understand the business before buying its shares. Number 2. More motivated sellers. During the recession, more than ever, you will encounter tons of people trying to sell off their investments. Keep your cool and don't panic just because the value of your assets is down. You want to accumulate your assets, not lose them, right? After all, your aim should always be to buy low and sell high, if ever. So why are people selling their stocks when the economy is bad and prices are so low, when they bought them way higher? That's because of emotions. Giving into emotions is one of the biggest mistakes people make when it comes to investing. They are so afraid that they might lose more money, they sell their investments and exit the markets at a loss. That's what you have to take advantage of. Use this once-in-a-decade moment to seize the opportunity, control your emotions, and buy quality assets at a bargain price. Number 3. The numbers are in your favor. Every single recession has produced the highest 10-year returns in the US stock market. Every single one of them. Time will always be in your favor when buying during economic downturn. So whether you bought a broad market ETF or handpicked a few quality companies, there should be absolutely no reason for you to panic and sell off the assets. Quite the opposite, you should buy them instead. After all, your investments will most likely recover and be stronger than ever because of something called the economic cycle. The economic cycle refers to the fluctuations of the economy between periods of growth and recession. In other words, after a period of big growth, companies will experience a period of stagnation or contraction. When this happens, many businesses will have to cut their spendings or even let some employees go. This is, however, not as bad as it seems, since this separates the wheat from the chaff, and good companies can then transit to another period of growth, which translates into the growth of their stock price. And that's exactly what we are after. Number 4. Don't overleverage yourself. We get it. Leveraging your investments is one of the most appealing ways of boosting your returns and acquiring new assets. But when it comes to recessions, maintaining a healthy level of leverage is crucial for navigating harder times. The last thing you want to happen is to have your hard-earned assets liquidated due to a margin call in your broker account. So opening any big leverage positions might not be the best idea right now. If you are already exposed to some kind of financial leverage other than the mortgage, it might be sensible to either deleverage some of your positions or at least think twice before opening any others. We understand that it might be tempting to chase the high returns with leverage, but you always need to consider the risk associated with it. Never forget that leverage might be a great tool in times of bull markets, but it can stink quite badly when it comes to the bear market. Number 5. Bitcoin is a great buying opportunity. Now, before you say, another finance channel shilling Bitcoin, hear us out. We get it. Amid the recent news of crashes, frauds, and bankruptcies, Bitcoin might have gotten a really bad reputation. But you shouldn't throw Bitcoin with other cryptocurrencies or centralized exchanges into the same bag. We can see the very thing Bitcoin is actually fighting against: having one single authority hoard all your coins. So if you are going to buy Bitcoin, always keep it safe. Remember, not your coins, not your crypto. That being said, Bitcoin has proven repeatedly in the past that it can recover from downtrends and climb up to new all-time highs. So ask yourself, how many times have you said, "I wish I have bought it when it was way cheaper"? Well, now it is cheaper. What are you waiting for? If you truly believe in Bitcoin, as we do, this is a great buying opportunity to accumulate some Bitcoin yourself. Those have been some reasons to invest during recessions. However, always stick to your own strategy. All of those reasons we mentioned are something we truly believe in, but it might not be what you believe in or even what works for you. It's always important to keep in mind that every person's strategy must be fit for his own financial needs and goals. So don't over-allocate your money into risky investments, even if it may sound tempting. Stick to your strategy, whether it's passive or active investing, and always do your own research.